But here are the contingencies on the second page: loan contingency, appraisal contingency, and an investigation of property. So those are the three that C mentioned: appraisal, loan, and investigation. And you'll notice there, guys, that if nothing is checked, it's always defaulted to 17 days. Okay, an agent might call you and say, hey, we want to make our offer more attractive, and they'll say, can we do 10-day appraisal or 10-day loan? Okay, they might even, I've done even 7. It's not even uncommon to remove the contingency and check on the very right, no loan contingency, no appraisal contingency. Okay, so be very, very wary of that. It wasn't uncommon during the pandemic where they want to submit such a strong or competitive offer. They will check no loan contingency and no appraisal and only leave this right here, the investigation of property. In other words, a home inspection. Okay. Now, you as a lender, are you responsible for the investigation of property? Do you know that? Are you in any way, shape, or form?
No.
No, good. Thank you, Paul. That's between the agent and the borrower, the buyer. Okay, so you don't have to worry about that. But you do, your concern is these two here, loan and appraisal. Okay, so once you know when the seller or the buyer has accepted that counter offer, that clock is ticking. You better get your file in, have the processing team disclose out within the day, hopefully no later than within 24 hours, at best within this, within the work day, okay, that you receive this, and you're ordering appraisal. Okay, any questions regarding the loan and appraisal? Pretty simple.
When they ask, say like, how many days of contingencies, what do you tell them?
Yeah, that's a great question, Alex. It really is. So yes, that does come up a lot, right? I mean, I'm sure, Peter, you guys can attest to, a lot of these agents will consult you and ask, hey, Alex, how many days are you okay with the loan and appraisal? Okay. The default answer should always be 17 days, right? Why? Because you and I know when we submit this loan file, like Alex, you experienced recently multiple times, and you even perhaps see, I'm sure, just because you get a loan conditional approval doesn't mean, right, this is a sure thing, right? We haven't really the sure thing when it comes to loan contingency. It really does. Your peace of mind should be CTC, correct? Yep. So once you got CTC, and even then, even at CTC, something could come up. There's no guarantee, but that's where you're going to feel a lot more comfortable. I think the industry has been trained to think loan approval, okay, to remove the loan contingency. But it really, if you want to be on the safe side, it should be CTC. Now, why is it on initial loan conditional approval? Well, because once you get the loan approval, for the most part, especially if it's a cleaner file, you'll know, even if it's a whole page of conditions, it's a lot of it's not something to worry about, right? Like it could be, we need the appraisal, we need the CPI from escrow, we need the air report for the appraisal, we need the invoices, we need the vesting. These are all things that are just admin work, but they're not conditions where it can potentially kill the deal, right? So let's just say it's further evidence of bank statements to prove income on a self-employment, because the underwriter is calling out for show evidence of self-employment income receipt. That might be a little bit scary, right? Because what if your client doesn't deposit their cash in their bank statement? Another one could be, what if the borrower hasn't quite worked their part-time job for 12 months? It's only been 10 and a half, and there's no exception to it. But the underwriter is saying, we need the VOE, right, to show that the borrower has been working for 12 months. Yeah, if that's a contingency, and you know for a fact that the borrower has worked for only 10 and a half months, not 12, I would be very, very hesitant in removing that loan contingency, right? So to answer Alex's question, it really depends. And this is why in 2 weeks, I'm going to go over mortgage consultation in 2 weeks, because next week we don't have a meeting. It's so important for you guys to do a thorough consultation up front, because really, to answer your question, Alex, only you, the consulting loan officer, okay, who's working with your client, only you can really truly answer whether or not a lower or a less days is acceptable for a loan contingency. Does that make sense? Right? Only after you sit with your client, hold credit, have seen their application, and when I say application, I'm not just talking about the 1003, I'm talking about all the supporting documentation. Can you then make a very educated guess, or make a very informed decision on whether, hey, agent Jane, yeah, I reviewed the file. I think honestly, we're going to be okay with a 7-day loan contingency or a 10-day loan contingency. Only you can do that. And I'm going to tell you why. Because if the file is not in escrow yet, we can't send it up into an underwriter. That's kind of a disadvantage that we may have in our platform, unlike the banks or the direct lenders where they allow TBD underwriting, right? We do have it to a degree. Gia and the team will review the file, and they've done a very good job, but we also know that they're not the end underwriter that's going to make the final call on this loan. So and because we're in a stage before going into escrow, the agent's going to call upon you to see, hey, Alex, Paul, Freddie, can we do a shortened loan contingency? That's on you. So it is imperative that you guys do a thorough job. Obviously, if you're working with a teacher, firefighter, police officer, and even then you don't even need overtime income, and you got a strong DTI of 43%, they're doing 10% down, 15%, it doesn't matter. Their credit score is good. They don't own any other properties. Yeah, it's safe to say you could probably even remove the loan contingency, right? I say that with a disclaimer, though. It's like, oh my God, Ragnar, how could you say just remove the loan contingency altogether? Because that's why you have your appraisal and your home inspection contingency. So during the pandemic, when things were just super competitive, a lot of loan officers, against perhaps the industry principles, said, hey, gave the okay with, go ahead and remove some of these contingencies. So as long as you keep one, right? It was a standard practice. I'm not advocating for it right now on this training call, but I'm saying it was something that was done. I saw that all the time, right? So, but you control that on the loan. Okay. Does that help, Alex? Yeah. Okay. So more important in 2 weeks, when we go over mortgage consultation, I'm going to show you how I do it, how I look through it. Hopefully that has, any clout there, as I've been doing this for a fairly long time. I like to be very thorough. Okay. Now, what I can address with the loan is with Giving Tree here. I'd like to think, guys, our team does a pretty good job in working pretty fast. Okay. Even if, knowing that we have to send this on out, right? When considering that we're non-del or even wholesale to another lender to review it. I mean, I have never, knock on wood here, and as Peter, as our leader here, who oversees everything, I don't ever recall getting a loan reviewed in more than 10 days. Okay. And I mean, from NMSI to Rocket to Mega to AmWest, Change Wholesale, Arc Home Loans, Acra, and I'm just naming off names of lenders that I've used. Harrington, I've never gone beyond 10 days. In fact, I would say, and not to give you any more assurance, but I would say majority of the time it's well within 7 to 5 days. Okay, that you're going to get your client reviewed, or you're in, at least for the initial review. There might be a one-off here and there, but for the vast majority, you're going to get your loan approved or reviewed. Really, I would say actually 3 to 5 days from submission, right? Anyone want to agree or disagree there? Would you say, guys, that's reasonable, that we've seen initial reviews within 3 to 5 days after loan submission?
I don't disagree. I don't agree or disagree. I just have a question about the removal of the loan contingency statement.
Yes,
you stated that, and I think I understand the principle behind it, but the problem here is I see, and that's the reason why I need to understand,
please,
is that if you remove the loan contingency, then if the appraisal goes good and the home inspection goes good, then and you still, the buyer still wants to back out of it, I don't see how they could possibly back out of it because you just removed the loan contingency.
Yeah, very good. That's a very fair question, Paul, and I'll go ahead and address that. And in the past, I said that I'm not advocating for it, right? But it has happened, and this is really from the point of view of an agent, okay? And I'm going to admit this, that I've done quite a few of them during the pandemic years and have removed loan contingencies, especially when I knew I'm working with a fairly clean file. And that's because the home inspection is the safeguard, okay? Because on just about any and all resale homes, there are more than enough reasons to say, hey, because of this, I just want to back out. Does that make sense? I mean, unless we're talking about a brand new spanking home, which we don't really deal with, builder homes, right? New build homes. Most of their transactions, I would argue, call it 99%, 98%, 95% even, of transactions that you and I and everyone else on this call were dealing with are resale homes. And many of these resale homes are going to be older. I would argue maybe 75 to 80, 85% of these transactions are going to be older homes, not within the 5 years, even 10 years. Now, that being the case, Paul, every home has some type of issue, big and small. It's going to be a variety, and it's going to be multiple. And again, this is what I've been told by many, many agents. And so for that reason alone, that is a safeguard where, hey, we can just say, because of these, we just don't like it, we're going to back out of it. Okay. Now, as long as it's within, again, the contingency period, right? So within 17 days, they just decide not to move forward with it for this reason. That's why they're saying, or why it was a practice by many here. Again, I'm not advocating for it. I'm not suggesting that you do this, but if you need to make in the cases that, an offer needs to be so secure, so attractive that they wouldn't remove the loan contingency. Good, Paul?
Yep.
Okay, thank you. And again, that's a great question. Again, I just want to say one more time, I am not suggesting and advocating for it on every single file, but in some cases where you do, like, you wouldn't do this on a non-QM loan, right? I mean, you could do it on a DSCR, but you got to be prudent about it, be wise. Like, you're not going to do this on someone who owns multiple businesses, owns multiple rental properties, and something can go wrong, right? But for those, it's a pretty cookie cutter A+ prime paper. It might be worth doing if it calls for that situation. Okay, but good question. Moving on here. So investigation of homes, right? So we went over that. Went over 3 contingencies. The two inspections are, again, your home inspection and the appraisal. So regarding those two, or at least the appraisal. It is your job as a loan officer. I'm going to say that one more time. It is your job as a loan officer to let the team know when to order the appraisal. Okay? I'm going to say that one more time. Once you've opened escrow, you've got the team has gotten the processing team has gotten sent the initial disclosures out, right? I would say it is your job as a loan officer to text, call your borrowers. Hey, initial disclosures are out. Can you please e-sign them? This is imperative to further move and proceed the file forward. Okay, why is this important that you do it? Because they're going to reach out to you anyways, and after looking at the LE and saying, why is my rate so high? What are all these fees, right? Can we lock the rate? They're going to reach out to you. And because they're going to reach out to you, you might as well be the one to get ahead, and because you want to get the initial disclosure signed, you want to reach out to them first and let them know, hey, heads up, you should have received an email. Please e-sign it. If you have any questions, let me know. I can help go through the initial disclosures with you. I here can honestly say, I don't know if Peter want to chime in, and see you too. In the many years that I've done this, I can probably count on maybe one hand, maybe two if I need it, if I have to think hard about it, how many people did not call me when they were signing their initial disclosures. Okay, there is something in the initial disclosures, whether it's the rate, the fees, the amortization schedule, the vesting, something, an incorrect something on the 1003. There's going to be some reason a borrower calls you when they're signing their initial disclosures. Okay, so it's better that you get ahead of it. They have to sign it anyways. Don't be afraid of it, yielding the call. Tell them, hey, the initial disclosure out, please e-sign them. Okay, because guess what? We can't do anything without the initial disclosures e-signed. Hey, Ragnar, my agent's blowing me up. Hey, hurry up and order. Why isn't the appraisal ordered? Well, the initial disclosures weren't signed. Whose responsibility is that? That's yours. Okay, so get the initial disclosure signed. Now, why do I bring this up? Because once the initial disclosures are signed, you then have to prompt the team to order the appraisal. Okay, I have been given direct order, okay, that we as the loan officers have to inform the processing team when to order the appraisal. So please make that a note, okay? As important as letting your clients know, hey, there's going to be an appraisal fee, there's going to be a credit report fee, okay? You have to be proactive, okay? Any questions on that? Okay, good. So know that after initial disclosures are signed, that is when that is a first available opportunity for you to then order the appraisal. So get on it, email the processing team. Okay. The only other things, the few other items that I want to cover, okay, are right here. Q3, the reports. Okay, termite clearance. Okay, so let me ask you guys a question. For agency, Fannie and Freddie, is a clearance of the termite report required?
No.
No. It could be if it states on here termite clearance report. Okay, so do you guys see this here? It says clearance report. This was a Fannie Mae Freddie Mac loan. This is a Fannie Mae loan. This is a conventional loan. And so we needed to get the termite. Okay, because it's on here. It is a condition to the contract, despite knowing, as C just said, Fannie and Freddie does not require termite. But what does require termite clearance? Regardless is if this was here or not. What loans require termite clearance?
FHA.
And
VA, FHA.
yep, and USDA. So all three government loans, Ginnie Mae loans, FHA, VA, and USDA, even if there's nothing regarding the termite here, okay, let's just say it's blank, you're still going to need the termite, not just the termite report, but you need the termite clearance report. Section A needs to be cleared, meaning the termite company goes out there, provides a termite inspection report. Section A says, this and this wood rot and termite infestation is active. That needs to be cleared. There needs to be that needs to be paid for, usually by the seller. They'll pay for it, and that will be the processing team will be needed to upload it to the lender. Okay. Any questions regarding termite? You guys are all good? Okay. So let's see. Let me go refer back to my little special requirements here. FHA again. Okay. Condo properties. So yeah, obviously we kind of beat this one to a dead horse last week. Okay. But if you see that this property is a condo, okay, right here, Q12, 13, and 14, okay? If you see that this property is a condo, look, I want to sit here and say that our processing team is amazing, okay? And many times they are, okay? But I will say too that like us as human beings, we sometimes miss things, okay? There's human error there. And sometimes we'll see a property, especially a property that may not have a unit number, right? So we're just thinking, oh, it's ABCD Main Street. Like, great, it's a house, and we don't think that there's an HOA involved. But like the case of this one, it does belong to an HOA. But it's not a condo, it just belongs to an HOA. So we didn't need a cert. But in the event that it is a condo, a HOA cert will be required. Notify your team. Okay, make it a habit. Like a habit. Okay, there's two habits that I really want to emphasize that you guys should do as loan officers. Is one, order the appraisal. Okay, prompt the processing team, please proceed with ordering the appraisal. And two, please proceed with ordering HOAs, the HOA certification. Okay. Any qualms or issues with that? It is your loan. It is your your duty, responsibility as a loan officer. Once you get this RPA, you're not just sending it to Escrow. Hey, Escrow, deal with it. Or I'm sorry, processing team, deal with it. Review it. And the two things are, again, when to order the appraisal and the HOA cert. Actually, I would even argue when you submit this, when you provide the RPA to the processing team, tell them to order the HOA cert ASAP so they know to do this ASAP. Any questions on that? No? We're good? We're in agreement? Okay, great. Finally,